Two experts, one hot topic, all sides explored. This is The Flip Side. The Flip Side is a podcast series featuring lively debate and opposing viewpoints on timely topics of importance to markets and businesses around the globe.
Welcome to The Flip Side, the podcast where we debate the forces shaping global markets. I'm Global Head of Research, Brad Rogoff, and today we're tackling a topic that certainly fits that bill. Are we finally ready to enter a multi-year bull run for oil markets? Joining me is lead equity analyst for European energy, Lydia Rainforth, who has been vocal in her research that she thinks oil markets are set to tighten and oil prices will move higher. Lydia, it's great to be here in London and actually joining you in person.
And I'm delighted that we get to do this, Brad, so thank you for inviting me.
All right, let's get into it. Oil prices matter hugely for the economy. Really for everything, right? So they're important inputs into transportation, industrial activity, even into power generation, and ultimately feed through to inflation expectations and the outlook for different economies. As with most markets, it's the forces of supply and demand that help set the price. Although there's also a bit of a political dynamic, especially right now, that's come into play here. When I think about the market as it is now, Lydia, it seems sensible to think that oil demand growth is slowing short term. The world is still dealing with the impact of tariffs, and although we don't know exactly what the outcome is going to be, getting a little bit better picture here, it's hard to see it being a positive for oil demand. Longer term, we've got electric vehicles becoming more common, and biofuels that are gaining some traction. So it's not really a question, to me at least, of if demand will peak, but it's more when. On top of all that, we don't seem exactly short of supply. The U.S. has plenty of oil, backed by an administration that's encouraging drilling, and OPEC is adding barrels back at a rate quicker than anyone expected. So when you put it all together, slower demand growth and rising supply, it feels like prices should be heading down, not up. That's what the futures market seems to be saying as well. So what about my kind of entry-level economics logic here is off and makes you think oil's about to rally?
Yeah, and Brad, I'm bullish because even with everything you just mentioned, and there's a lot there, the general view that oil prices are headed lower, the data's telling me a very different story. The fundamentals are tightening. What we're seeing now is something the oil market hasn't seen in over a decade. Spare capacity is being drawn down. And that sets the stage for a scenario where prices could keep climbing for years. And for each of the factors you outlined, I understand the short-term focus, absolutely, but there's a lot more going on than it initially seems. So we've got to dive deeper into each one.
All right, so you mentioned data. Everyone who knows me knows I like data, so definitely your best chance of convincing me. So let's go right into the demand side. Start there. So it feels like the most important piece to get our heads around first, right? Would you agree with that?
It is, and it's often the hardest bit to look at. So after Liberation Day and the US tariff announcements, a lot of people expected global GDP growth to slow. And that makes sense. If growth drops by about 1%, we'd usually expect oil demand to fall by about 300 to 350,000 barrels a day, out of a total of 105 million barrels a day. So yeah, that is a headwind for us.
And that's really a linear approach you're going with there, right? And on top of that, there's always the chance of real disruption. So for instance, what if shipping between China and the U.S. suddenly stops?
Yeah, and that's a great point, that it could knock off another 300 to 400,000 barrels a day. So there are certainly good reasons to be cautious. But the tricky thing with demand is that it's super unpredictable. What looks solid in theory doesn't always play out the same way in reality. We also have to factor in the tensions in the Middle East, which aren't just about supply. While oil flows haven't been too hard hit, natural gas has seen some disruptions. And because of that, a few countries in the region have had to switch to burning diesel for power instead of gas. That's probably added around 300 to 400,000 barrels a day to oil demand just in the last month and a half. So there's real things going on out there.
Yeah, that really highlights why demand's so hard to get a clear read on. You're not talking about really one input here at all. And there's a lot of uncertainty right now.
And you're right, the range of demand forecasts in the market is really wide. The International Energy Agency, or the IEA, thinks demand is up about 700,000 barrels a day this year, whilst OPEC is saying it's more like 1.3 million barrels a day for 2025. And as you go into 2026, the gap between forecasts gets even bigger, and then it gets bigger as you go out into 27, 28 as well. So really wide range of forecasts here.
Well, you're not going to be surprised to hear that I think the market's got it right, probably. And, leaning towards weaker demand makes sense to me. And part of that is we haven't really seen the full impact of U.S. tariffs yet. Now, we know they're not going to be as extreme as they could be, or as we thought maybe they would be with the first announcements, but the broader economy hasn't really felt the hit either. But you're saying demand is still holding up. So what are you seeing that makes you think it's stronger than people expect?
Yeah, well, here's the thing, Brad. When it comes to supply and demand models for oil, the margin of error is often bigger than the actual difference that we're trying to figure out. Especially with demand, it's made up of billions of people doing all kinds of things. It's you and me going to fill up our cars, for example. It's businesses running diesel generators, that sort of thing. And that's why the real signals we look at are what we call refining margins and inventory levels. In Q1, the model suggested inventories should have built by about 1 million barrels a day, but they didn't build at all. So the models were off by a full 1 million barrels a day, and that's greater than the difference we're trying to solve for.
Yeah, that seems huge. What kind of anomaly in the data is this?
We've seen this before. It's what we've called a missing barrels phenomenon. And usually it's a suggestion that demand is stronger than expected. At the end of the day, refineries are the ones that use crude oil. And what happened after Liberation Day was pretty telling. Despite all the talk of weak demand, refining margins, which is the difference between the price of crude oil and the price of products that we use every day, like gasoline and diesel, actually hit an 18-month high. That's not something you see when demand is soft.
That's fair, but where's the demand actually coming from, and really where's it going to come from in the future? I mean, most markets, as I alluded to earlier, haven't really felt the full impact yet, at least, of the changes in global trade.
And that idea of yet is a really tough one to push back on. It's almost impossible to disprove. And to be fair, there is a seasonal element to demand. Right now, we're at the peak end of summer and what we like to call driving season. Demand naturally dips as we head in towards autumn and winter, and that's something we see every year, so it's not unusual. The big question is whether demand will decline more than normal. And that's where it gets interesting. The strength in demand isn't just coming from China anymore. China's been the big story in oil demand growth over the last decade, but now we're seeing growth from the Middle East, from India, from Southeast Asia, and even Europe's surprised us a bit on the upside.
That might be true for now, and that's a short-term view, I think, because let's talk about the concept of peak demand, which there has been, I think, a lot of talk about recently. And the energy transition is still chugging along, even if the speed is slowed in some places. China, for example, is really encouraging EV adoption. It feels like that market may have already hit peak oil demand for transport, at least. And if we're starting to see a real drop in the area that has been the major source of demand for growth for the next decade, it's not exactly an exciting outlook for long-term demand growth.
I disagree here. I don't think the world is going to hit peak oil demand growth this decade. If anything, peak demand will probably arrive in the middle of the next one at the earliest. You're right, though. China's transport demand has probably peaked, and that growth engine isn't what it used to be. Electric vehicle adoption outside of China hasn't really lived up to what the policies were aiming for, though. So to hit peak demand this decade, global economies would need to deliver more progress in EV adoption than they have so far. That said, I also think that some of the industry forecasts are underestimating how fast things are changing. As usual, the truth is probably somewhere in the middle. So if I think back to those IEA and OPEC scenarios, I think something like 1 million barrels a day of demand growth each year, halfway between the two, out to 2030, is a pretty realistic scenario. And we've also got to remember that moving away from oil isn't cheap. And this is why economies are not doing it as quickly as planned. Every barrel burned puts out about half a tonne of CO2. If you price carbon at $100 a tonne, that's like adding $50 to the cost of each barrel. When oil's trading at $70, it's a tough sell to argue for adding that kind of inflation to internalise the cost of carbon. So I've got to come back to the idea that the global economy just needs a lot of energy of all types right now, and peak oil demand just isn't on the horizon right now.
Honestly, maybe the best conclusion it can take from the demand discussion here is that it's really hard to predict demand, and we should probably talk about supply, because that might be a bit easier to actually narrow in on. And if we go with your point about the error band for those demand forecasts being so wide, I mean, it almost feels like it doesn't matter right now compared to supply. If you think about OPEC sitting on a bunch of spare capacity, U.S. shale can ramp up pretty fast, and there's a wave of new production coming online from places such as Brazil, Guyana. It's starting to look like there's just too much oil out there, and that could easily push prices down, I would think.
And your point on demand is a good one. The reason to be bullish is actually a supply one rather than demand. And there's a big shift happening in supply when you compare the next decade to the last one. Over the past 10 years, North America, basically the US, was responsible for all of the net supply growth. Without US shale, we wouldn't have seen any real increase in global oil supply, which is kind of amazing when you step back and think about it. But now that growth from the US is slowing. At around $70 a barrel, US shale might add only 100, maybe 200,000 barrels a day each year at most. And if prices drop below that, production could even fall. And that's just the reality. Costs have gone up. The US is running out of what I would call tier one inventory, the easiest and cheapest stuff to drill. So if the US isn't adding much, producers have got to find that oil somewhere else. And the thing is, no one has really had to do that for a decade. That's a big, big ask, especially when new projects take years to ramp up, not months.
Before we get into other sources of supply, what about President Trump's drill, baby drill approach? The U.S. administration wants a combination of energy independence and lower prices, right?
They do, and it's easy to understand why. But here's the thing, lower prices and higher production just don't really go hand in hand, at least not without some serious incentives. The break-even price to drill a new well in the US has jumped from around $49 a barrel in 2020 to about $65 a barrel now. That doesn't mean no one's drilling, but on average, higher prices are needed to make it worthwhile.
I agree. That does seem like it's hard for those two things to go hand in hand, and producers can't ignore the basics.
That's right. So unless there are some big industry-specific tax breaks to bring that break-even price down, it's hard to see a big production surge ahead. And I think what US shale has done for global supply is incredible. But we've got to be realistic about where things are now and where we go to. And that brings us to new non-OPEC supply. We're expecting around 600,000 to 700,000 barrels a day of new supply in 2026, but that pace really starts to slow from 27 through 2030 as the industry keeps battling natural decline rates. For now, OPEC has enough spare capacity to handle disruptions. That's why we didn't see a huge price reaction when the Iranian nuclear facilities were hit. But for the first time in a decade, the industry is starting to dip into spare capacity. And for me, that's a bullish signal for prices, not a bearish one. And it's got to be the point I keep coming back to.
So how should we think about the cost of these barrels relative to the oil price right now? So what you said is it's probably about $65 per barrel to profitably drill a new well in the U.S. right now. Is it cheaper in other places?
It is, and this is important. OPEC can bring back barrels that are economic well below even $20 a barrel. And some of the new fields in Guyana, Suriname, Brazil are economic below $35 a barrel. And that's a big change over the past decade. 10 years ago, it would probably have cost at least $80 a barrel to get offshore barrels internationally on stream. Today, that price absolutely needs to be less than $50 to get the go-ahead, and most are trying to get the cost down below $40. So they are coming in cheaper now than the US barrels.
Well, that's got me a bit confused here. So if the international projects are so low cost, how does the price go up?
Yeah, and that's a great question, and it's about scale. US shale uses lots and lots of producing wells that can come on very quickly and stop very quickly. A lot of these international projects I'm talking about can take 3 to 5 years to build and start producing. And in 2020, the energy industry mostly stopped exploring for new oil and gas. That's had a huge effect on where we are today. Sure, the projects coming on stream now are low cost and hugely competitive, but there simply aren't enough of them to offset declines elsewhere. Without new investment, 4.5 to 5.5 million barrels a day of production capacity is lost every year. Can that gap be plugged? Yeah, absolutely it can. But in the meantime, the market fixes that supply-demand imbalance with higher prices.
So what I'm still struggling with here is the lower cost oil meaning higher prices, though. And Lydia, I can't help but notice you're kind of skipping over the rest of 2025. We've seen OPEC ramping up supply, and there are the big new projects that we just mentioned coming online in Guyana and Brazil. I might be able to get the longer-term view that you're espousing here, but can we really just brush past what looks like a significant supply wave heading into the end of the year and what's probably the riskiest point for oil prices?
Yeah, that's a fair point, and I will admit you're right on this, and I feel most nervous around the end of this year. Some big fields will start up in Q4. There's 3 in Brazil, 1 in Guyana, and a few small ones elsewhere globally. Combined with OPEC supply having risen over 1.5 million barrels a day since April, and that's a lot of supply coming to the market. demand seasonally weakens. So that does mean inventory builds probably show up in fourth quarter, but that's okay. It's something we see this time of year every year, and it might be a bit faster this year, but the market already knows this. And given what I'm looking at into 2026 already, we need an oil price that encourages supply, not destroys it.
So we talked about producers needing incentives, but I don't think they're the only ones. Getting gas to my car takes refinement and a broader supply chain. What about the incentives of those entities?
If we go back to the prices of diesel and gasoline, the products crude oil is used to make, in Europe, prices are already hitting nearly $99 a barrel for diesel and $85 a barrel for gasoline. When refiners are making money out of this, they have to run harder, and that needs more crude. I only worry about crude prices sustainably falling if those refiners start to lose money, and that feels a long way off right now. So in the short term, there is enough supply that prices don't shoot up overnight, and that's fine. But the idea that oil's heading towards $50 a barrel or that prices are in a lower forever world, I just don't buy it. Every week, the fundamentals are proving tighter than expected, and to generate the production required down the line, the right price signals must be sent now. Basically, higher prices today make sure there's enough supply tomorrow, and that's what refining products are telling us.
All right, well, I'm just going to still take some convincing on the short-term arguments you made here, but listening to you, it does seem like the drivers of the oil market for the next 10 years are very different from what we've seen in the past decade. There's a bigger role for international crude suppliers compared to the U.S. and different sources of demand growth outside of China. That's an important insight because these changes will have significant effects across various economies and markets, and not just for oil. We'll have to watch and see what happens in the short term, but it's clear this is a topic that can't be ignored. With that, our time together has come to an end. Thanks for hosting me here in London, and thank you everyone for listening to this episode of The Flip Side. If you like what you hear, don't forget to subscribe. And if you're a client of Barclays Investment Bank, you can read more in Lydia's latest piece, What If a Multi-Year Bull Run is on its Way? Available now on Barclays Live. We are not making any recommendations to buy, sell, or invest in oil as a commodity or via other financial instruments, which involve substantial risks and may not be suitable for all investors. Until next time, see you on the flip side.
That's all for now from this Barclays podcast. Thanks for listening, and we'll catch you next time on the flip side. For more insights on this topic, clients can log into Barclays Live or find out more at barclays.com/IB.